Good morning.
Morning, Charity.
Hey, Chris. Yay, we got Pisa, right? Yes. Awesome. George, Jim. Yay, Jim, you joined. Awesome.
Thank
Good
you.
morning.
Yep.
Hi, Curtis. How's everybody doing? We got an awesome treat for you guys today. Some really amazing investment opportunity and insider info, kind of, but not really, right? Yes. So welcome to the Tuesday Mastermind, and let's do just like a round and talk about who we are and what we do and introduce ourselves to the group. Curtis, let's start with you.
My name is Curtis Van Drysh, and I'm a coach. Better man coaching, like confidence, belief, and like a community-centric type of like thing. Student of charities for a while, and that's who I am.
Yay. Yes, Curtis has a all men's coaching group for young entrepreneurs and people thriving, and he's doing an amazing job. All right, Chris.
Hey, good morning. I am Chris with Owen Professional Services. We help small to mid-sized businesses get their revenue engine tuned up. So we work on everything from marketing and lead gen to sales process, sales management, and wrap it up on the customer success and referral generation side. So our target,
Awesome.
yeah, absolutely. So my wife is on the call. The two of us work together on the company.
Yay. Hi, Pisa. So happy you made it. Do you want to add anything to that?
No, I don't really need to add anything to that. Yeah,
Okay.
pretty spot on.
Yeah. Awesome. Jim.
Yeah, good morning, everybody. My name is Jim Kay. I work for a company called Sales Acceleration. Basically, I'm an advisor to small to medium-sized businesses, helping them build sales infrastructures to drive growth. And I appreciate you inviting me, Jerry. Thank you.
Thanks for being here. And our guest speaker today, George.
Yes, George Roberts from Horizon Multifamily, and I offer individuals the opportunity to invest in multifamily real estate without having to deal with the tenants, toilets, and termites.
Yeah. Yes. You take it all on and provide an awesome opportunity. And I was really intrigued being in real estate. I always knew multifamily is really where it's at, but it's not that easy to get in if you're not accredited and have $1 million balance sheet already, right?
Right. Yes. We'll definitely talk about that today and the ways that you can get in.
Awesome. Cool. And you guys know me, Charity, CEO of Answer Group, and I'm helping stimulate the CEO crossing community. And also some of the guests here have been on my podcast. So hoping for much more integration with you guys, learning more about what you all do and how I can help as well. But it sounds like y'all might be able to help me stimulate my top line. We got 2-3 sales gurus here, that stimulate the revenue gen. So that's big. So all right, George, let me let you share, and let's get into this high level review of multifamily syndication models and investing.
All right. Awesome. So let's just make sure I have the level set straight here. You're giving me most of the hour, half the hour, or what? What do you want me to do?
Yeah,
here?
we can just do a Q&A after and talk about, strategies, questions. I'm sure there'll be some. So it's you've got the floor. Yeah.
Okay, great. Yeah, I wasn't planning on taking the whole time, but that's perfect because I think we can go into a little bit more depth. Love it.
Yeah.
All right. So today we'll talk about investing in multifamily syndications, and that may sound like a mouthful, and maybe you're coming here today and not thinking, hey, investment is what I'm into. So let's start with some motivating examples, right? So first of all, why is it great to be a landlord? Well, according to John Stuart Mill, landlords get rich in their sleep. Of course, it's not quite that simple, right? There's a lot of work that goes into it. You got to buy it right. You got to figure out how to finance the deal, how to manage it properly. And you don't really make your money until the exit. At least not your greatest, you're not going to get to your IRR without that. So what do we really do here? Okay, so as landlords, we get rich 4 ways. The first is cash flow, and I think this is the best. It's one have an investment that literally throws off cash all the time. You don't really get that from the stock market, right? If you're getting 2% dividend, varies from year to year. What do you get then out of, $5 million? Like, wow, whoopee, now I can live on $100,000 a year. Crazy, you really can't live like that if you invest in bonds. You're not going to get the appreciation. So it's very, very difficult to construct what I would call a standard portfolio that's going to give you a decent retirement unless you have, say, upwards of $5 million tucked away. So by the way, I'll let you know that, I'm not your attorney. I'm not your CPA. I'm not here to give financial advice. I'm just here to tell you what I've found to be valuable in the investing world and to share some of my experience. So let's leap right into it. And again, as another motivating example here, you see, what is this here? This is, of course, mailbox money. And that is the goal. All right, so there are many ways to get rich in real estate. Why multifamily? So the main reason is that this provides economies of scale. I mean, think about it. You can go out there and buy a single family home, and you can buy another and a third, but that's a lot of work. I know a lot of people who have become millionaires buying single family homes, but it's a full-time job. These people, I guarantee you, are not getting rich in their sleep. And eventually they end up wanting to become a guru or something because they want to step aside. They get tired of having to transact all the time. So I recommend, why not just skip all that flim flam and just cut to the chase? Why not make some really big deals that not only provide the cash flow appreciation, amortization, and tax benefits, but give you the economies of scale that allow you to do it in style. So first of all, I explained cash flow. That's pretty obvious. So what about appreciation? I think that's pretty obvious too, right? Real estate tends to increase in value. When you look at the stability of asset classes, real estate tends to be towards the top. Something great about commercial real estate we'll find is that you can actually force the appreciation. You're not tied to the comps. If you get this building to perform at a greater level, you bring the costs down or you get the income up, boom, you're instantly richer. So amortization, that's kind of a big word. Basically, that means that every month that you pay that loan size goes down. And at least on paper, you're getting richer through amortization. And finally, tax benefits. We talk about yield and returns all day long, but guess what? It's only what you get to keep that matters. And real estate comes with extraordinary tax benefits. You may have heard of some people in news, maybe even lately, who don't pay taxes. Why? Well, one of the number one reasons is that they invest in real estate. And of course, when you sell your real estate, you do get a tax bill at the end. So what's the solution? Well, when I talk to my friends in real estate, they tell me the solution is buy more real estate. Gotta love it.
Nice. Is all this making sense to you guys? Do you want some definitions, since I'm the accounting background on amortization, depreciation, appreciation? Is everyone really comfortable with those words?
Yeah, definitely. My wife has an accounting background and I'm pretty close to it as well. So
Perfect.
I love financial people. Counting is just amazing. It brings a new dimension to life. So again, we're going to talk about the economy of scale because this, I think, sounds obvious, but I think when we get into it, it's more than you realize. So how about a rhetorical question? Do you want to have 20 roofs, 20 furnaces, 20 separate AC units? Absolutely not.
No, thank you.
Do you want to drive to 20 different locations? And even if you do have somebody managing the property and you have your own handyman, etc., do you want to send them to 20 different locations? Forget it. Buy yourself a 20-unit apartment. Now, at this point, you're probably thinking, well, wait, either I don't have the money for a 20-unit apartment, A, or B, that I have that much money, but hey, I want to diversify. And that's where we're going to get into passive investing. So not only is multifamily real estate amazing, but being able to do it passively, I think, is even better. And I do both, by the way. Obviously, I'm in the active side, but I invest passively with other operators as well. And there's some reasons. I'll get to that in a second. Here, first of all, I'm going to move these controls so we can see things a little better.
So you're saying that this is the syndication model passive?
Totally passive. You can have the option to come in and have literally no liability, right?
Yeah.
If I do something wrong, they can come after my assets, but they won't be able to come after you.
Wow.
And in general, even when you're active, it's still non-recourse. So there's something that's colloquially called a bad boy carve out. These are called springing guarantees in the financial world, but we like to get a little cute with the terminology. So if you are one of those bad boys out there, and for example, you don't maintain the property or you don't pay the taxes, there are generally, and you have to, people ask me like, hey, well, what can happen? Can I list all the possibilities? Absolutely not. You got to read your agreements. Read those agreements, but generally you're going to see several of those springing guarantees. But even so, it's 1,000 times better than investing in just about anything else, because again, you can get that non-recourse loan, and then at that point, it's like the residential, but with the economies of scale. Okay, so
you
why
can get,
multifamily?
you can
go
get
ahead.
funding from the bank for this passive investing, or it's all cash up front. No, you can't like, oh, I need a $250,000 line of credit. I want to invest in your new, $10 million unit you bought, on the East Coast.
Right.
Or
So
is it
actually,
you
it's
have
funny. I
to-
was having a conversation just this morning with a banker about the possibility of doing that. I have opened up these lines of credit, and I wouldn't necessarily recommend it's like investing on margin. But
Okay.
again, if you got, say, a huge stock portfolio and you want to borrow, X dollars, and it depends, of course, on your financial situation. Sure, I mean, you could do that. Again, I don't know that I would necessarily recommend that. But again, the minimums here could be like $50,000.
Okay.
And when I think about investing, and sometimes it's lower, and some sponsors are going to demand more. So it's really very much deal driven. But again, if I think about investing in single family real estate, what am I going to get for $50,000?
Mhm.
And I love that you bring this up. I was going to hit this a little later, but say you got $50,000, okay, and you got like an 80% loan to value, okay.
Mhm.
So what do? You go out and you buy, say, a $250,000 asset. Fine,
Mhm.
maybe you can Airbnb it, whatever.
Yeah.
But it's really, really hard to do that. And when I talk to landlords, they tell me, hey, I don't leverage my assets. I own them outright. Well, why? I mean, isn't that one of the great reasons to invest in real estate? I mean, again, I wouldn't invest in the stock market on margin, but if you look at real estate transactions, essentially you've got like a 4x, 5x leverage.
Mhm.
And in the stock market, the best you can do is 2. And I would still call that absolutely nuts, bonkers. I would never, ever invest. Sorry, I said that 3 times, but to me, it is just crazy. Literally
To leverage your
nuts
assets.
to do
Let
that.
me understand. Sorry, I got lost after the your point about leveraging your assets, because I've worked with a lot of CEOs, business owners that do. It's just to be able to get additional cash flow to get into another investment, which is you're saying is completely bonkers.
Well,
right?
what I would say is what asset class are you in? If you're investing in equities, totally nuts. Forget about
Right.
it. But when you invest in real estate, it's not crazy to have a 20% down payment and control a much larger asset, because
Yeah.
you have the cash flow, because the prices of commercial real estate in particular, even much more so than residential real estate, tend to be stable. And again, it's all relative.
Okay. So
Yeah.
it isn't necessarily completely bonkers to do that for another real estate asset if it's commercial or has an ROI or has right?
Fair
some
enough.
kind of-
I don't want to stray into providing financial advice, but certainly you could do that. And,
Okay.
you know, I'm considering doing for some very, very what I consider safe assets. And again, having, you know, many times that in terms of my own personal balance sheet, cash flow,
Mhm.
and liquid assets to be able to do that. But again, when I'm talking about leverage here, I'm talking about something with a very, very stable asset, something that's very, very, again, far from equities as possible. But
Right.
yes,
Okay,
you're
gotcha.
right, Charity. You could get, say, a secured line of credit, unsecured line of credit, and nobody can stop you from investing in whatever you want to do. But then to get back to diversification. So why do we diversify, right? Because, you know, if it were all about getting rich, that would be one thing, right? That's almost easy. The real game is how to remain rich. And so you diversify because you don't want to see your entire portfolio go down at one time. If you can invest in something that's stable, so much the better. So let's
Mhm.
take a look at multifamily real estate. And what we're looking at here is trends in rent. This comes from CBRE research. So blue here is a negative growth trend. Green is how long it takes to get back to the prior peak after recession. Recession here is the orange line. And green is the amount of time you get to grow past the prior peak. So in this case, we're talking about the Great Recession over here.
Mhm.
So we got the Great Recession occurring, and all of a sudden, you see this negative growth trend. Even before the economists say that the economy is in contraction, there's a negative growth trend in rents. But for multifamily, as compared to industrial, office, or retail, that negative growth trend is shorter than any other asset class. We're talking 5 months, 5 months, less than half a year, where you're out there really hurting and collecting less rent, less cash flow than usual. Okay. So it took 7 months then to grow up to that peak. And then at the time of publication, you had 29 months to grow. 29 months. Whereas if you were in retail, you were hurting for almost 2 years. And at the time of publication, you hadn't even returned to the rents that you saw before the recession. So not only
What
is
about with
commercial,
COVID? Do we have numbers from this?
you know, we do.
massive
And
crisis?
I didn't know you were going to give me the whole hour. So I had this set up to go up to my compounding slide.
Well, because I want to
So
ask you a bunch of questions. I want to pick your brain, and I want everyone on this group to do it as well, because it could be really, you know, insightful for long-term investing ideas. A lot of people aren't hip to the syndication model, knowing that you don't have to put your name on the mortgage, leverage, you know, a 30-year mortgage, that you can just actually have the big guys do it, and they do all the work and the groundwork and find the investment, and then they just pretty much pay you your 18 to 30% ROI at the end of the day after 5 years or something, right?
yes, exactly. I'm telling you, this is the way to do it. And
Charity,
I
you're
wish
listening well.
I wish I could project 18 to 35% IRR, but we're projecting high into those double digits, I'll show you something today. I think we're projecting in 15%
Okay.
plus IRR,
Plus
17%
IRR, which is the
AAR.
appreciation model, right? Because that's just return on your investment, cash flow.
Exactly. And I
annually.
apologize. I've used that term twice now, haven't I? So that's the internal rate of return. And, you know, again, I know that we have a pretty financially savvy audience, but I would just think of that as the rate of return. And I think when we get a little deeper into the numbers, I can explain exactly how that's calculated.
Okay.
So here we have the prior recession here in 2000. And I thought in my book here, we did have COVID, but I know those statistics do exist and we can go and dig those up, but you can look that just basically any recession, boom, the resilience here is just amazing. And if I really wanted to drive the point home, this is just comparing various forms of commercial real estate.
Okay.
And there are other forms too that we could include. For example, senior living tends to be very stable.
That's huge.
Oh,
Oh my,
yeah.
Yeah.
baby boomers all need a nice, cool resort to live in. For the the new senior
You know,
living
and
around
that's
here
actually a
is
trend too. If
nice.
you talk to Robert Kiyosaki, he is building those resort style. He says, he jokes about how he wants to be in the penthouse. That's
Yeah.
why he invests, because when it's his time, he's going to go to the penthouse of that luxury resort senior living. And that is definitely a trend. And hey, more power to you if you want to invest in that space. I would tell you one of the best things about being a passive investor is, look, you can really only be an expert in one thing. I focus on multifamily, but I'm also looking into other opportunities, other forms of real estate, some transactions going on right now that I won't be able to talk about, but it's beautiful to be able to invest in senior living, in hospitality, to
Yeah.
have your finger in multiple pots. And it's one thing to be able to vet a deal, right? That takes a certain degree of sophistication, but it's nowhere near what it takes to actually sponsor the deals. So I'll sponsor deals in multifamily, but hey, I might invest in self-storage, for example.
Right. And so you're saying that the syndication model, you can approach different investors that may have, let's say, 20 location chain of pizza joints, and they need an equity investor. Is that still considered? But then you're like partners. So syndication is like no liability, no, you don't have to even disclose your name, right? You can just say, oh, well, I got 20,000 and I want an ROI, and they own all the commercial, and you don't actually have to be liable also like an equity investor, right?
Absolutely. That, I think, is one of the best things. It's just like investing in stocks on the New York Stock Exchange.
Nice.
You can lose your investment, but they're not going to come after you for your assets. And at the same time, you do get many of the benefits of being a business owner, right? You get to join the LLC, and then you don't have to be there every day. Take part in the meetings, vote on important transactions. To
So
me,
the
I think it's
syndication group is a LLC, and then you become a member of that, which protects you from all the other investments you're in, right?
yeah, that's awesome. And so I don't know if I should sort of pivot to that, which again, since we're going in depth, we can kind of go through my book, and I'll show you how to get this at the end. It's still free, although I am going to publish this. So if you are
cool.
watching today, you are lucky. You can still get this free, but publishing this book is something that I have very much on the horizon.
Awesome.
So here we
I
go.
can't wait to read it. Then I'll stop asking you all these questions.
No, that's okay, because I love it, because you're really drawing this out. So before I jump, so I'm showing you just various classes of commercial real estate. If I were to compare the rate of default in residential real estate versus commercial real estate in any recession, huge. My friends in the single family business, sometimes they lose everything. And a lot of investors I know, I say, hey, are you an investor? And say, oh no, I was, but the Great Recession wiped me out and I'm just done. And that's sad, because I see people, they may be realtors, they may have everything they need to know. They have the financial savvy and maybe even the financial wherewithal to do it, but they're done. They're just done. And that's really sad to happen. So I would prefer to see people focus on commercial real estate. Also, it's one of the things that's growing. If you've been following the housing starts, the reason why our housing starts are increasing and have gotten to the level of our historical average is multifamily. We've been moving towards a renter nation model, and we're going to need more apartments for everyone to live in. And this is really more of a renovation play. I'm more on the value add side. And imagine what would happen if we don't renovate our real estate, if there weren't flippers, and if we didn't have value add syndication deals like this. Essentially everything would be reduced to rubble before you know it.
Right.
So
and you're doing
absolutely.
the more green friendly, quality for everybody, creating good insulation, happy, healthy, green communities, kind of.
You know what, you are resonating my heartstrings, because I think a lot of people look at being eco-friendly as being like, hey, let's rip all this out, throw it in the garbage, and replace it with something that's more efficient. Well, maybe, but I'll tell you what, my idea of being eco-efficient, and sometimes you do have to rip out something that's old and which is inefficient, is, hey, let's renovate it. Let's save this. I mean, what went into making those bricks and that mortar? What about the trees? What about the workers and them driving to work? So again, anytime you can, just like everybody who's green would tell you, hey, to reuse is better than to recycle. So just reuse. And that's what this is really all about. It's about really getting the maximum value out of these structures. And we're going to need to do this. We can't build fast enough, not enough qualified builders. And that's another industry I'm involved in. But again, we can't build fast enough.
Mhm.
Okay, so let's talk just a little bit more about like why real estate, why multifamily. So the economy is leverage. I told you about how my friends in the single family space, a lot of times they don't even leverage their asset because they say to me, hey, George, if I'm getting $200 of cash flow a month to manage this property, and then most of that goes to the bank, forget it. I'm done. I'm just going to own everything outright. So they're not even taking advantage of leverage in single family. Tax advantages.
George, I've got a question. When you talk about leverage, can you explain what that, I kind of got it when you were explaining that scenario, but when you're saying economies of scale, leverage means the amount of money I'm putting in, I'm getting more margin back. Is that?
Exactly. So think of it as your
Okay.
cash on cash return. If you have a 20% down payment or 25% down payments, you can just make a ton of money because there's a huge spread generally between where interest rates are now, your mortgage rate, versus what you may be getting as cash flow. And so you're really multiplying. That's the best thing about real estate to me, is that you can control a large asset with a small amount of money.
And you can rearrange the deal, right? Is that what you mean? Like after like 3 years, you got like $250,000 in equity and the interest rates have gone down. So you want to pull out because it's accumulating the value, appreciating as well. Is that what you mean by leveraging it? Like you would just rearrange the deal?
Yeah, I'm just
pull the
talking
money
about the
out,
mortgage, plain and simple. I'm just talking about the mortgage you have on the property.
Right.
You are allowing a small amount of money to control a very large asset. And you're getting benefit from the whole amount. And remember, the bank, they're making out too, because they're using leverage as well, right? They may have $1 in the vault someplace, and they're loaning out 10.
Nice. And do you guys use like those compound interest payment strategies so you can eliminate like $250,000 of interest in a term or do you guys just play with the bank, stick to the deal, rearrange the deal when the time is, cash out, rebuild, add more? I mean, is that really kind of what the model is that you just keep going with what the economy of scale is, whether it's, the interest rates are going down, your property's appreciated, then you can like take the money out and then get another one.
Yeah, absolutely.
Right?
That refinance is a huge part of the returns.
Okay.
So I think we got a pretty financial audience here. So in case you're not fully aware of what the internal rate of return is, let's just say that money now is better than money in the future, right? Because at worst, you could invest that money if you had no use for it and you could get more money. So what is the rate of return that you demand? Okay. That preference is very subjective. So what should the discount rate be? In other words, should $100 now be worth $110 next year? Well, that implies a 10% discount rate. Well, what I like about the internal rate of return is that it's very objective. Okay. When you look at all of the cash flows from a deal, that internal rate of return, everybody is going to come up with the same results. Whereas if you look at discounted cash flow, well, what's your discount rate? You're going to get different numbers. So when we project in the future, there's uncertainty, but when you look at all the cash flows, you're all going to come up with the same number for internal rate of return. And that's because you're going to set that discount rate to what it takes to set all of those future cash flows essentially to zero. So essentially, you're letting mathematics determine, hey, what was the discount rate in a certain sense. So to really squeeze all the IRR you can get, you have to get money back to people quickly. And that's great because, again, I feel like there's a sort of a psychological resonance there, okay? Your IRR depends on how quickly investors get their money back. And so, again, this is the intuition that people feel when they put money in a deal. Hey, when do I get my money back? What does the cash flow look like? And at the very end, how much do I get? And so those three metrics would be your cash on cash return, the internal rate of return, and the equity multiple. So many of these deals, you get an equity multiple close to 2. So you can look at it many ways. Like, hey, I'm getting like a 15% internal rate of return. The deal lasts about 5 years. At the end of the deal, if I put in $50,000, I should have almost $100,000. So those are basically the 3 ways of looking at the deal.
Nice.
So tax advantages. If you have a W-2 job and you're making exactly $100,000, you get the maximum tax advantage. You can, I think, take, and again, I'm not your tax advisor, but I believe it's $25,000 off of your income if you're owning your real estate actively. So how would that happen? Well, I'll tell you how it happens is because you do something called a cost segregation study. And rather than depreciating that asset over 27.5 years, it all goes into accelerated depreciation. So you may get, say, an 8% rate of return on a multifamily investment your first year, but your tax return is going to show a loss, okay? And you can zero out some of that W-2 income. And since W-2 income is taxed so heavily, that is a huge thing. Now it phases out between 100,000 and 150. The rules may change at any second. And you definitely want to consult your CPA, but you're making at around 6 figures, you get the maximum advantage of investing in real estate.
So with the buyout,
yeah.
with the buyout of the syndication model, you pay capital gains?
Yes, you are going to pay capital gains at the end, but again, my answer to that is just, hey, buy more real estate.
Yeah, can you do the exchange? You can do a 431 exchange, right?
Yes, the 1031 exchange
1031,
still exists, and I believe it will continue to exist. It looks like we dodged that bullet. So what Charity is mentioning is that if you, it's called a like-kind exchange, and so let's say you have some commercial real estate, you can exchange it for some other commercial real estate, and that's beautiful because it defers the taxes. And ideally, what happens is you defer that until you die, and then your children are going to get that real estate at a stepped up basis. So essentially they may pay taxes, but if they do what you did, then you just continue to build wealth throughout the generations. So that 1031 exchange is great. It's hard to make that work though with a syndication. There are ways that it can be done, but it's more difficult. Not every sponsor is going to offer that in every deal, but you can do that.
Good to know.
Yeah, but again, if you're always building your wealth and always investing more of it in real estate, you can still essentially pay no taxes. And that is the goal. So forced depreciation. If you have a single family home and you're a landlord, what can you sell that home for? Well, only for what similar homes in the neighborhood have sold for in the last year. That's called comps, sales comparables. But with multifamily, as I mentioned, if you can reduce your expenses or if you can charge more rent, like for example, I'll show you a deal where the landlords, they're not charging pet fees. In fact, they don't even allow pets. Pets are so common these days, right?
Yeah. And that's a bigger top line. You can increase your top line. People are paying arm and a leg for their pets these days.
Huge, right? And when you renovate, then you're going to be reducing your expenses, and that'll show up hugely then on the bottom line. So reduce the expenses, increase the revenue, boom. Either way, you're increasing the NOI, you're increasing the value of your asset. So you can literally force the appreciation. If you're a good manager, it's not like a fix and flip, which is a pretty good model. But when you fix and flip an apartment, you're getting paid not on comps, but on the basis of your ability to manage. All right, so how can you invest in multifamily real estate so actively? And hats off to you if that's what you want to do. I think it's a fabulous road to go, and I would love to train the next generation of active commercial real estate investors. But while you're getting a handle on these very complex transactions, I would say invest passively. You're going to learn the business, and you're going to be able to expose yourself to more phases of the business than you possibly could if you were investing actively. You just can't be an expert in everything.
Yeah.
So then the question is, how do you become a passive investor? So the hardest part is really probably finding a sponsor. Now they're all over the place. You can find these gurus on YouTube. You can find podcasts. Just look for keywords like multifamily or passive income. Once you find a sponsor, and obviously I'm here today, I'm here to tell you I am a sponsor of such deals. If you're interested in investing, come schedule a call with me. You can find us on horizonmultifamily.com. Fill out a quick questionnaire and we'll reach out to you and figure out what your goals are and how we can help you. But you also have to know a little terminology, and I wouldn't counsel anybody to hesitate. Okay, if you think this is for you, call up and we'll help work this through. But you may be one of those people who, yeah, I want to know a little bit before I make the call. So you have to know what bucket you're in. So there's two types of deals. There's deals generally for people who are accredited. So these are people who have $1 million outside of their primary residence, or they earn $200,000 a year alone, or $300,000 with their spouse. This makes you an accredited investor. And there are some other classifications and there's some complexities, but basically that's it. You're rich and you are accredited. And it sounds funny because it sounds like if you're accredited, like, well, what did you do? Did you take a class? Did somebody certify you? No. You're accredited whether you know it or not. Some people in this audience are accredited and they may have just found that out today. So if not, what you can do is you can become what you have to do is you have to establish a substantive relationship, a substantive relationship with your sponsor. And what it's called is a sophisticated investor. So
Is
if you
that
own your own
gross or
business-
net? Sorry.
Oh, you're talking about the
The 200K
income that would
revenue.
be, that's gross.
Oh, nice.
Gross. Okay.
Yeah, gross. Yeah, absolutely. So some people will qualify with or without a spouse. Pretty cool if you do. So then the idea is you may still be a sophisticated investor. And what that means is that you fully understand the risks that you're going into. So I would say personally, to me, what I would consider somebody who can understand the risks, obviously you're running a business. That's evidence that you understand risks. Are you investing in various types of securities, investing in debt, bonds, etc.? You know, that's a sign of sophistication. Do you have an accounting background? Sophisticated, again, it doesn't mean you have a degree in finance. Okay, you don't have to be an accountant. It means you have to fully understand. So that means we're going to have a conversation. I need to know about your background. And again, I need to know about your goals. I can't take your last $50,000 on earth. That wouldn't be good for either of us, because then you have people clamoring to get out of the deal. And I have to explain things like that this isn't a liquid security, and that's not fun.
Is that a minimum 5 years, most likely, the hold?
Yeah, I would say most likely, because the deal could last longer. If the economy tanks, maybe we have to just keep the deal alive on cash flow, may not be able to sell it at a decent price. So I would say, you know, figure hey, we want to be out of the deal in 3 to 5 years. It may be 5 to 7, but realize things can go wrong. And it's like any other investment, you could lose the total of your principal invested. Not more than that, but totally your principal invested. And so it's just like investing in equities or anything else. But again, hey,
With inflation and all this uncertainty in the market, do you find that it's a higher risk now? Or it's more
yeah.
safe?
So I'm going to answer that two ways. Certainly there's more risk in the market right now, but there's also something called opportunity risk. And wherever you are, you're going to sustain damage. There will be damage and dislocation when the economy takes a tumble. So would you rather be in something like an equity where earnings are going to go down and people are going to need their money? So you're not only going to get the same earnings multiple that you were seeing in the past, it's going to be worse. But again, those earnings are going to go down. By any metric, your stock portfolio is going to take a major tumble in a recession. On the other hand, cash flow tends to increase with inflation. Do we think inflation is real? Absolutely. Some people are just waking up to that reality. I think those of us who are a little more financially savvy, we saw this thing coming. I mean, if you were to ask me, George, where has inflation been? I would say I have no idea. I don't trust the official statistics, but even if we just a priori trust their statistics, I have no idea how we dodged so many bullets with so much monetary inflation. And finally, we jumped the shark. Again, and not here to be political in any way. It's if you've been paying attention to what's been going on, it's the Fed, which is really neither party. What the Fed did to get us through COVID inflating the money supply, that's funny money. And you got to expect something's going to happen. So do you want to be in equities where you may get pummeled and where you may not outpace inflation, right?
Mhm.
Bear market comes, you're going to be way under. Or do you want to be someplace where cash flow is likely to increase? So I would say I'm happy where I'm at. I'm certainly diversified. I love diversification. If you want to learn more, you can come out to www.horizonmultifamily.com. Download this ebook. Yes, you have to give me your telephone number and your email address. And yes, we will call and we'll reach out and we'll see if we can schedule a call with you and if there's a way we can work together. But again, it is a free book. And again, total high quality here. This is something that I will be looking to publish. And as you see, start with everything from the history. I go through what is syndication, which, by the way, I didn't really cover in much detail. So what is syndication? Essentially, it's two or more investors pooling their resources to make an investment that neither investor could have made on their own. And if you want to know how far it goes back, you can go essentially right back to the beginning of history. You can find cuneiform inscriptions of people who pooled their money together to make these various investments. Common in shipping, people would not want to put all their goods on one ship. They'd hedge their bets a little bit, or they would go in shares. So again, the idea is really old. Empire State Building, probably the most famous syndication.
Oh,
May not have
nice.
known that, but before, I think it's sold to a REIT now, but there was, technically it's a sandwich lease. So they had a master lease, still have a master lease on the Empire State Building, and I think that was sold to a REIT. But in the 1960s, $10,000 would buy you a slice of that master lease.
Wow, that's what I
Yeah.
want in on, something like that. Where's that at, George?
Yeah, exactly. So I can't sell you a slice of the Empire State Building, but I have a lot of great deals. And you know what? I haven't been looking at
Yes,
time at all.
let's see some of them. Can you show us like what?
Yeah, exactly. Yeah, I see. Yeah, never mind. We don't have any time for those exciting math examples I had planned for
Oh,
today.
great.
Hey, George, real quick before you kind of go into that, this has been very interesting. One thing I'm trying to figure out. So, how does the sponsor make money, right? So, I mean, so your business, like, how do you get your cut? Like, how do you all make the money brokering these deals? What's your model? What's your revenue model?
Yeah, sorry, my head's just spinning here. I got messages coming in, etc. How do we make our money? You know what? I could show you that really quick if you don't mind. So here, if I can search through the book. Whoops.
Well,
I'm
you
not
also
gonna-
hold a bigger piece of the pie. So you get the ROI and the cash flow, right? So it makes your deal sweeter because you have more equity now in the deal, or?
Exactly. So we're going to get some equity as soon as the deal starts to go well, as soon as investors get their money back. And the answer is it's called a waterfall. So I could show you a waterfall for some various deals, and I could show you exactly what that looks like. Yeah, here we go. Ta-da. Oh, no, I'm sorry. Right. This is just the capital stack. So it just shows you how people get paid back. So that's not exactly what you're looking, but it sort of leads into.
Yeah, it's
So
kind
the
of,
idea is,
if I think about annuity or equity, right? So if I'm investing through a mutual fund or something, I know that I'm paying a load, right? I'm paying a certain percent off whatever I invest in my 401k. I'm paying a percent on what they manage, and so that's why I was just trying to understand kind of what's
no, that's a
you know,
perfect question, Jim. So it's not like a direct load like that. Now there can be fees, like we would class that as a fee. So there could be an asset management. So there may be, let me name some of the fees since you mentioned load. Okay.
mhm.
You can have an acquisition fee. There could be a disposition fee. There could be a capital event fee if you refinance, for example, because all of these things essentially take some work. And the asset management, essentially, that would be closest to the load of what you're talking about. So again, that comes off the top line before anybody sees anything. But again, based on your cash invested, generally these deals are going to come with a preferred return. And that preferred return is generally cumulative. And in many cases, so the investors are reasonably protected. If the deal goes well, you should get your preferred return.
Mhm.
And once you pass that hurdle, then most of the money goes to the limited partners who put the money in for the deal. And the rest will go to the general partners who are busy running the deal. And by the way, in these deals, the sponsors are usually putting in between, say, at least 5 and 10% of the equity. And it depends. I mean, for a really small deal, it might be 20%. Deal that I'm in right now is about 20%. Okay. For a smaller deal in double-digit millions, it might be closer to 5. But again, they're always going to have some skin in the game. So they're investing essentially right alongside with you. If you're one of those financial geeks, it's called pari passu. It means essentially on the same footing. And then if you get over a higher IRR hurdle, which in this example is 12%, then you're going to have a better split from the GP standpoint. But the idea here is like, hey, you've already kind of made your money. Once you get to the point where it might be a 50-50 split for the equity you put in, you've already got that 8% preferred, and you're getting the 70% on, and this includes capital events too, right? So if there's a refinance event, certainly by that point, you'd expect that the return hurdle has been met, and then you're getting generally a significant amount of your money back here, and you're going to continue to get money on the basis of the capital invested. So you're still going to get 70% of that capital.
So just to drill in a little bit more about what Jim was asking. So what I heard from you is that it's not really, being the sponsor isn't really that lucrative. It's just like the engine to help do more deals. And you're really just doing it out of opening up opportunity for investment. Your nut is really in the equity or in the preferred, being one of the preferred holding, right? Like what is
Right.
and
Right.
to
So let me
generate
walk you
more-
through a deal. So let's take a hypothetical deal. Like let's say you have an acquisition fee. Okay. So you're going to get paid a little upfront as a sponsor, and you might put in 20%. So I got a deal where I'm putting in, I shouldn't say but it's the general partners together are putting in aggregate 20%. So we're going to be then taking out, pari passu with our investors, 8% on that portion of the equity.
Yeah.
So we get paid a little bit up front because, again, there's a lot of deals that fall through, and it's a lot of work. Any of these deals, you're going to be working on 2, maybe 3 months, very devoted work. So we get paid a little bit at the outset. It's good for us to have money in there in the deal because, again, that allows us to take some of that pref too on the same footing. But again, we don't really get paid in a big way until we either have a capital event like a refinance or until everybody's getting their preferred return hurdle.
Right, when you sell. So being the sponsor is really just actually generating more opportunity for more cash at the front of the investment to create more equity cash value, not necessarily to make a return on those that are investing. Right. I think that he's doing because that's a lot of effort for you guys to go into bringing in new non-accredited accredited investors and having to do like the management of that and being able to, send out the quarterly reports and hold the board meetings and to give them the opportunity to make the money. So I think what he was saying is like really what is in it for you, but what you're saying is that it's really not there. It's actually in the
Well, it's
preferred
there, but
equity.
it's more on the back end. So
Yeah.
again, after the refinance, that's when we start to generally pass these hurdles and pass them by a pretty large amount. So after that capital event, maybe we're passing, say, the first or even the second hurdle. We may have at that point done a lot of renovation. So we may have forced the rents up. Like, for example, I'll give you a live deal right now. We actually put a Facebook ad out where we ask for $250, almost $250 more than the going rent. We're testing the hypothesis that rents have not been raised for 3 years here, and that we're severely below market. We have severe loss to lease, and that as soon as we pick this up, that we can start to pick those rents up. I mean, even before we have started to renovate the property.
Mhm.
So there's an idea of like, that's the sort of value add. When we do that sort of value add of either renovating the property and increasing the value, or we get the below the mark rents and we bring them up to market, then we're passing those hurdles and we're getting our money. But again, so what's in it for the sponsors? Potentially plenty, because at the end, we may be getting 50% of what comes back to us after all of the capital has been returned to the investors, after the preferred return, and after we actually dispose of the property. There is that potential for a huge windfall. But again, it comes to the middle and the late end of the deal. Earlier in the deal, we're getting compensated, but it's no windfall.
Got it. It's a long-term wealth generating plan for you guys, right?
It is absolutely. And
It's
it
not
can,
a
people,
short-term.
yeah, people can move up very rapidly in the business, because if you get acquisition fee for everything you do and you're staggering your deals using other people's money, you can absolutely have many irons in the fire. And before you know it, you're always getting a new acquisition fee. You're getting asset management fees. You're refinancing. You're getting your preferred return, et cetera. So it's absolutely very lucrative. I don't want to claim it isn't, but again, the business model is really that the investors get their money, and that then we really start to see some major returns as sponsors.
Awesome. Well, was that helpful, Jim?
Yeah, no, it is. Thank you. It's kind of just a different model that I think that I'm used to in terms of understanding from an investment standpoint. So
Me too.
appreciate it.
And I've heard a lot. And that's why I've just been like picking George's brain since I met him.
Yeah,
I'm like,
yeah,
hold on,
no
that
kidding.
actually sounds really, really feasible and really intelligent way to invest right now, being everything else in the market is so uncertain and everyone always has to have a place to live. And then in real estate, just knowing that multifamily is
Yeah.
always been, one of the better strategies for investing, and then not having to be the landlord, not having to deal with the capital improvements, and just show up to the board meetings
Right.
and get your quarterly reports and just hang on for a few years. I mean, hey.
Yeah, no, there's a lot of it sounds like a lot of benefits to it for sure. Yeah. It's interesting, George, you kind of referred to it as commercial real estate. So multifamily is kind of categorized as commercial.
So that it's really the best of both worlds. And it's commercial in the sense that you can push that appreciation and you can get commercial loans for it, which have some pretty amazing terms. Actually, residential has some amazing terms in its own right. But at the same time, the IRS classes it as residential. So you get the quicker appreciation, but yet at the same time, you can force the appreciation and you don't just have to live and die by comps.
Interesting.
Nice. That's
Right,
fascinating.
like, yeah,
So
you get
we're-
that single family home and you turn into an Airbnb and you do all the work with the city to make sure everything is good and right, and you make amazing cash flow. But when you sell it, I guarantee you're still getting it. What you're getting is just what the comps, because even if an investor buys it from you, well, they're probably going to get a loan. And when they get that loan, it's going to have to appraise. And the appraiser is not going to say, well, the highest and best use of this is as an Airbnb. No, they're going to say, this is a single family residential home. And I'm sorry, this is what it appraises
This
at.
is the fair market value for
Yeah.
it, right?
they
Yeah.
don't consider ROI or revenue or
Right.
yeah.
All of those
Interesting.
things that us highfalutin finance people like you and I, Charity, things that we love, they
Yeah.
ignore all of that.
Yeah. And that's the city. That's at the state city level, actually at the realist, like you're saying, when they're looking for comps, you can't look at it as a business. You have to look at it as just a residential
Right.
property.
Yeah.
Interesting. Well, that's so insightful. We're see how time flies when we're having fun. We have 6 minutes left. So if we look at a couple of your deals, like pictures, and you can show us like what the opportunities are, just, so we can see where you're at and what's in the pipeline. I know you have some things you can't disclose. You have some bigger, awesome deals
Well,
going.
yeah, we usually don't put the whole webinar out. Usually it's sort of like a sort of thing that you have to sign up for the webinar and all that. But I do put this out on LinkedIn. That's the one great thing about working with accredited investors, is that it does open things up a little bit. I can go to my meetup and I can talk about this. I can talk about it on the internet. So yeah, again, I can show you some things, but again,
That's your team. That's your investment.
that's our team. So yeah.
So if we were to
Uh,
invest the come together with some money, this is the LLC that's formed that executes all the heavy lifting, those guys?
Yeah, exactly. So the main thing is like, look, when you get something together like this, and I don't think I'll go through I think it'd be fair if I just skip certain things like
Mhm.
the expected and projected returns. But here's the guy who found the deal. He worked on it for years, has a great story behind it.
Wait, Darren or who?
Sorry, Tom, I was trying
Tom.
to, if
Oh,
you can see
Tom,
the
got
mouse
it.
pointer. Yeah, so he found the deal. He went out and went through all the trouble of, talking to our property manager slash handyman, said, hey, if you ever want to sell it, let us know. Well, called back a couple times, got a couple no's, but the second no turned into a yes. A couple weeks later, he got that call back saying, hey, we would actually be willing to work with you. Let's get a meeting together. So next thing you know, we're the only players on the field. So this is a total off-market transaction. People will say like, yeah, oh, I got this deal from the broker. It's off market. Right. Yeah. You plus their other 10 best buyers got to see that deal.
Mhm, mhm.
So again,
And that was my other question. You guys do like county auction foreclosures? Like, is that like a sweet spot for you guys? Like with this COVID and all the restrictions and people defaulting on all their obligations, is there just like a huge market for just going to the county and seeing who defaulted on all their tax payments and go just get a banging
So
good
that's a
deal?
great way to find distressed properties, especially if you're buying like under 100 units, even particularly under 80 units. If you want to find out who has code violations, that may be an exhausted landlord, somebody who's willing to get out. People who who are behind on their taxes, who knows what trouble they're in. They may need to sell quickly. So absolutely, if you're looking for those off-market deals, they exist. And a lot of people.
But does
especially
your
that
group do that? So there's this huge equity gain at the end of the day?
Well, what I would say we are more focused on the various people that I've been working with. We tend to look at things like personal relationships. So we have a lot of broker relationships. We like to know the property managers and these are the sorts of things you can't get as a beginner. This
Mhm.
is why it leads to the very best deals. If you are a beginner and you want to if you want to break into the business, you're not going to see those off-market deals because you don't know all the property managers, you don't know all the players in the business, and you really don't know, who's selling, right? Nobody's going to bring it to a noob. And so what you want to do is you want to get out there and you want to partner with people. That's really the way to make it in this business.
Yeah.
These are large transactions. So you partner with somebody bigger. And that's what I've done throughout my entire career. And as I get bigger, rather than sponsoring small or medium deals, I'm just going to sponsor even larger deals by finding additional great partners who are very deep into it. But as for how these deals look, again, I really shouldn't go through the whole thing, even with a confidentiality disclaimer, but what they generally look like is you're going to see well into the double digits of IRR. Okay. Maybe 15% or more again, and it's all very much deal dependent. And it's all projections. You have to vet the deal. And do you believe it? Right? Do you believe it? And when you get to the point of reading the subscription agreement, it's going to give you every reason why you shouldn't invest in it. If you've been reading annual reports, quarterly reports, there's a section just like that for your equities. Like, anything could go wrong. Only this one will remind you that it's unregistered securities. You're nuts. You have no recourse. You can't sell them on the open market, and 10 other reasons. So again, it's for very special people who have a little wealth, people who want to manage and for themselves and who want diversification.
And
I
you
mean,
guys
by
have
the,
all the filing teams, you have the attorneys, you have the brokers, you have the CPA, you have everyone to design the deal. So it's a winner.
Absolutely. And that's the greatest thing about syndication and multifamily investing in general is that we're talking about a team sport here. Okay. I'm not the lawyer or the CPA. We have lawyers and CPAs that we consult. I don't need to know everything about the SEC. I need to know certain things like if it's not a 506c deal, I can't go out and talk about it on the internet. But
Right.
because we're limiting ourselves to accredited investors on this deal, we can. But apart from that, it's the lawyers that keep us out of trouble. They make sure that all of the appropriate disclosures are made in our private placement memoranda and the subscription agreements. And that even when we have a webinar, that we have the appropriate disclaimers. So again, yeah, that's the great thing about it. You really only have to be an expert in one thing, like say investor relations. Someone else can be acquiring the property, somebody else can be managing it. You end up becoming an expert in one thing, and you just get to run in that lane.
Yay. So that's awesome. On that note, everybody, George with, sorry, we're running out of time here, but I just want to make sure that you deliver your final pitch of where they can book a call with you to get more information. So if any of you are interested in talking with George on a more, professional, not in this group setting, because I know there's a lot of other questions we could be asking him, but it's probably not appropriate. Money questions do, so.
Exactly.
We
I
like
can
to
be
keep
much
that
more
at a-
forthcoming on a
Yeah,
call. And
so-
so you can reach out to me at www.horizonmultifamily.com, fill out a quick questionnaire, and that'll give us an idea, getting to know you. We'll schedule a call. That's the way to go. Also, you can reach out to me through LinkedIn, and that's another way to establish the relationship. And again, we'll do the same thing, fill out a questionnaire, have a quick call, and then you're essentially on board. You can view our opportunities. And from there, again, we would continue to build that substantive relationship. But again, it all starts out with reaching out. And again, download that ebook. You can find that as well on the website. And that will also get you in line to get a call and to talk to one of our
Awesome. I'm going to
principals.
get that book. Then I'll be like, I'm an expert in syndication now.
Yes.
But then I need to put some skin in the game. So don't think I'm not going to. This is on my to-do list. Thank you, George. Thank you, Jim. Everyone who stuck around. That was awesome. I appreciate all your value. And I'll see you next Tuesday, 7:30. We'll have some more amazing guests to share what they're doing and opportunities for growth for all of us. Y'all have an amazing day.
Yeah, thank you guys. Have a great Thanksgiving. Take care.
You too. Ciao.
All right. Thank you, Charity, so much for the opportunity to do this.
You're so welcome. I am so happy you did. So,